Hello again everyone, I hope you're all doing really well. In this video I'm wearing my Seattle Supersonics hat because it is symbolic. I purchased this hat on the same day that I had my one and only dining experience at a Wendy's. It was located inside the Seattle Tacoma airport as I waited for my red-eye flight to Boston late in 2016. Living in Australia, we do not have quite the same level of game when it comes to fast food options. So when I did my gallivant around your fair nation, the underlying secret mission of my tourism was to sample as many of the American fast food chains as possible and crown who really is the Burger King. If you stick around to the end, I'll let you know how Wendy's fared and all that. Anyway, aside from personal anecdotes, I recently came across this article published on Nasdaq titled "Wendy's Serving Up Some Hot Sales." I will spare you the full details and just give you my executive summary of the piece. That being, a major analyst in Wedbush Securities has placed a buy rating on the stock with a 12-month price target of $28.50, which is about a 28% upside on the current share price of $22.77. So it's a bit of an eyebrow raiser, that one. The analyst cited that the company looked to be on track to beat earnings expectations this quarter on the back of growing popularity of their new breakfast offerings, as well as expanded capacities in food delivery, digital segments, and a seeming greater degree of customer loyalty. I wonder how much of that is down to the meme stock mania. Anyway, so this got me a little bit excited, as I wouldn't mind investing a little bit of money into some of the fast food chains, and I have often held an ambition of owning a franchise myself one day. They are mature and stable business models which are very easily understood. Also, understanding how these businesses grow is pretty straightforward. They either expand offerings or open up a new location. It's tried and true. Anyway, so before I follow Wedbush and throw my hard-earned dollars at Wendy's, I thought I should dig around and see if buying Wendy's stock is the best use of my hard-earned money if I were to go down the avenue of investing in a burger joint. So to do this, I picked two similar listed businesses to compare Wendy's stock with, those being McDonald's and Burger King, or as it is traded, Restaurant Brands International. Together, the three represent the largest hamburger chains in America and quite possibly the world, although Wendy's is still yet to make it to Australia, so come on, let's get down here already. So to start with, I thought I would take a look at what other brokers and analysts were saying about these three companies rather than just relying on one. And what I found is that they're bullish on all three businesses. However, it would seem McDonald's is the slight winner in this regard, with 74% of analysts giving it a buy or higher rating, compared to 63% for Wendy's and only 54% for Burger King. Brokers in general seem to rate all these companies quite highly. However, it is only McDonald's that has entirely no negative ratings, so we have a clear favourite here in the eyes of the brokers and analysts, it would seem. Now, moving on to some key metrics underpinning the stocks and likely informing some of these brokers' decisions, it actually seemed that McDonald's was again coming out on top in most of these areas. Perhaps most importantly, in the last 12 months, they have had the best ROI and normalized PE ratio, that being the PE ratio averaged out over 5 years. I think it is more relevant than the regular PE ratio in this case, as it takes into account a broader performance of the company, including the impacts that we've experienced with the pandemic in recent times. Anyway, so while in all these key performance metrics, Wendy's was close to the middle of the pack, one thing that I found quite interesting about all these companies is that all actually have negative tangible book values. And to me, that made a lot of sense once I remembered how primo burger jockey Ray Kroc had structured the McDonald's business.
Is there a problem?
A big one. You don't seem to realize what business you're in. You're not in the burger business. You're in the real estate business. You don't build an empire off a 1.4% cut of a 15-cent hamburger. You build it by owning the land upon which that burger is cooked.
All of these businesses have huge amounts of debt on their books as a way of funding the real estate to which they operate on, and that's actually where a lot of the value in these businesses are. So while the negative tangible book values may be a shock on the untrained eye, it's not really that big of a deal when you realize the values of the assets they are controlling, and especially when you consider the low interest settings we are currently living in. However, when you look at this in terms of the amount of debt you would be buying per dollar when you invest in one of these companies, there is quite a bit of a discrepancy, and it actually seems like Burger King, with 74 cents of debt for every dollar invested, may possibly be over leveraged. By comparison, McDonald's has the least amount of debt, which would suggest that They are the most profitable, hence perhaps why they have the healthiest ROI. Wendy's, despite being in the middle of the group for net debt for every dollar invested, has the worst ROI. So this is likely down to a flat performance in the share price in recent times. So from this chart, unless you are a dividend investor, of course, Burger King really stands out as the least impressive investment option. They have the lowest normalized PE ratio and the highest amount of debt per dollar invested. Generally, Wendy's seems to operate in the middle ground, but they have the worst ROI. But strictly speaking, McDonald's actually seems like the standout on most of these measures. So from a fundamental perspective, McDonald's gets the win yet again. Next, just taking a bit of a look at a few charts to get an idea of the trading patterns over the past 5 years for these companies. Wendy's has generally had a nice upward trend. However, since the pandemic and the company's recovery, the stock has largely traded in a flat pattern. Burger King, which has had a much choppier experience, and I think this is a reflection of the fact that they are the most over-leveraged and have the highest dividend payout. As such, the company is not investing as much of their returns back into the company, and this is reflected in the significantly lower amount of stock price growth over the past 5 years. Again, McDonald's is perhaps showing the effect of economies of scale. Other than the pandemic drop-off, you can actually almost draw a relatively uninterrupted trend line to capture the share price growth, to which it has achieved the highest of the three, 117%, over the past 5 years. Back to Wendy's, it would seem that Wendy's has put a respectable effort and managed to keep pace with McDonald's to an extent, with 105% growth over 5 years. If we refer back to the article and the potential 12-month price target of $28.50, if realised, it could mean that Wendy's may actually overtake McDonald's in terms of retrospective share price performance. That said, it did seem like an ambitious growth target, especially considering that Wendy's is not considered a growth company, but rather a mature business. So just some more food for thought. Anyway, onto some final thoughts. It would seem there is a strong optimism for this fairly stable industry going forward, and you could make an argument for any of these companies to be a good investment. Burger King for its dividends, McDonald's for its stable growth and economies of scale, and Wendy's for its competitive and comparable performance to McDonald's. I think Wendy's also potentially has a bit of an X factor in the sense that they are the smallest of these three companies, which gives them the greatest room to be able to innovate as well as pursue aggressive expansion. I mean, hello, they are not even in Australia yet. Anyway, if you're looking for the safest bet, you can't really go wrong with McDonald's stock in this area, it would seem. However, just referring back to the article one more time, the article actually does contradict itself to an extent. It speculates as a whole that the industry is likely to not be affected by inflation or rising commodity prices, including labour costs. But the article does also mention being able to meet the labour needs is a potential constraint of growth for Wendy's, as it probably would be with these other restaurants. I know for a fact that at the moment beef prices are at record highs and there is now a shortage of beef stock, which will likely lead to driving up of prices of what is probably the most expensive ingredient in their key products, those beef sandwiches. Also, the labour costs are likely to go up in a high inflation environment, and when you add in a labour shortage, that may mean there will need to be some sort of premium to attract the labour, or at least a cost worn by the company to maintain its current profit margins. So it's not as rosy an outlook for the company as the article paints initially. Anyway, so if it was up to me, I'd probably be putting my money on McDonald's, but I don't think Wendy's is the worst option either. All three of these companies have something unique to offer an investor. And that leaves me with the only other loose end to tie up. What was my pick of American fast food options from my trip? Wendy's I gave the third place rank to, but my overall winner was Shake Shack, which I had while I was in New York. Anyway, that's about it for this one. What do you guys think about Wendy's stock? Would you invest in it? Do you have a favourite fast food chain? Let me know your thoughts in the comments below. Until next time everyone, may the markets trade in your favour. Cheers.